Okay, I want to walk through some examples this week from Chapter 7 with bond value calculations. And I'm selecting these directly from the textbook from pages 231 and also on pages 237. Then I've created an example as if there are semi-annual interest payments, because that's more the reality with a lot of bonds. But for the sake of explaining the concepts, we're going to work with just assuming that the interest is paid annually, and then we'll look at an example where it's paid semi-annually. One of the things we have to remember about bond calculations is that there's an inverse relationship. That is, as the required rate of return or current interest rates rise, we should expect that the present value would fall, and vice versa. You know, that if current interest rates drop, and we should expect that the present value or the value of that bond goes up, because it's all about opportunity cost. If I have a bond that is currently paying 8% and interest rates go up to 10%, well, somebody else is going to want that 10% bond relative to my bond that only pays the 8% rate. So what I'm going to have to do is I'm going to have to lower that price of the bond in order to get it to a rate of return that is 10% for the investor. So changes in interest rates definitely have impacts on the value of bonds. And the other thing to remember too is that just the demands for bonds themselves can impact the return. If the stock market's not doing very well, it could also drive a lot of people to want to go purchase bonds. It can be good for you if you own those bonds and it goes up in value, but it could also mean that the rates of returns that you get on certain bonds, or if you were to purchase a new bond, could go down for you because now the price has been driven up so much that if you were to buy that bond, you'd probably get a less of a rate of return. All right, well, let's walk through some of these examples here. And notice what I've done here. I've kind of put the values that are the answers. And what I'm going to do is I'm going to walk through and kind of explain how I got the results for all of these. So first, let's do the price of a bond. This goes back to our previous week. This is present value. So I want to know how much I would pay. And again, this concept of present value means what is it worth to me today? So really what we're doing is when we're discounting a bond back till the date of today's date, we're discounting all those future cash flows back. You know, the $1,000 I'll receive in the future. In this case, you know, we're going to have payments for 4 years, and the interest rate at 0.05875. You know, the coupon rate, but we have this current interest rate of the 0.0416. So let's do this here. I'm going to go ahead and jump in here. I'm going to go f of x, and we're going to find present values under financial. Well, go back here a second. I'm going to find financial and PV. So I get down and scroll down to PV. I'm going to say OK. So if I go back and I kind of look at this again, I'm not going to put that one in there, but I have to put the current. Let me close out this, kind of remember what the current interest rate is. I'm going to have to write down some of these details. So we have 0.0416, and let's just remember that one. So, all right, 0.0416. Put that over here, 0.0416. All right, let's look at some other details. We have the rate here is 0.05875, the coupon rate. So 0.05875. Okay, and I think we also had, in this case, it was 4 years till it matured. So I got enough detailed information. I can go off of it now. So let's go back here, f of x, find PV, present value. Okay, so we said that the current rate was 0.0416, what an investor can receive. The number of periods was 4 years before this matured. The payment, since the coupon is 0.05875, we're going to take 1,000 times 0.05875, and when the bond matures, we get in 4 years we get our $1,000 back. So there we got it to match up. So it's saying I should be willing to pay $1,062.02 today in order for the right to buy this bond. All right, yield to maturity. Let's look at this one. So we got to take some information here. So this one we had 7 years, 0.0875. So let me look at that. So we had 7 years, and just check that again. We got 0.0875. Okay, 0.0875. And I'll pick up my other information, and it looks like we 700 purchase price. Okay, 700. All right, so we should have enough information now here. So let's say that in this case, I want to use the rate functions. Go f of x, find rate, Hit OK. So the number of periods here is 4 years. This example, let's pull this down a little bit. So we have $1,000 times 0.0875, so $87.50 a year. I pay $700 for that. In the future, I'm going to get $1,000 back. So, and let me just check on my math here. So I have that at 4. So we need to change it to 7 years. So that's what it was. Okay, so we got 7 years here. And yeah, now we match up okay. So I got a 16.22% or 23%. We just want to maybe bump this out a little bit. So I'm going to dump out the number of decimal places, and then we have it match up. Okay, next for current yield, the example we have here is just saying that we receive $40 in coupon payments a year and we paid $920 for bond. There's no f of x function that we're going to use for this. We're just going to divide the two values. So I say equals, check the value here again. So we got 40 and 920. So I'm just say equals 40 divided by 920. And it says the current yield, just looking at 1 year, not the entire length of the bond, but current yield, when you hear those stated, is just the rate of return you would get that year if whatever coupon payment you received divided by what you paid for that bond. All right, so let's look at our next one here. We got 864.10. We have 10 years to maturity. Current rate's 8%. Coupon rate is 6%. So I have all my information here. So we're going to show that how it changes a little bit when present value is semi-annual. So f of x, find PV, okay. Hit OK. We got a rate here. We have 8%, so I'm going to do 0.08, but since this is semi-annual, and again this is current rate, so I'm going to divide that by 2. Since it's 10 years, I have to say 10 times 2, because it's every 6 months we're going to receive payment. And the amount of that payment was, since the coupon rate is 6%, that would mean if I took 1,000 times 0.06, it'd be $60 a year, but I got to remember this is just twice a year. So we're not going to get $60 every 6 months, we're going to get $30. So let's divide that by 2, and then that gets us okay. And again, we get our $1,000 back in the future, and then we have it's all good, it matches up. So we would be willing to pay $864.10 for the right to receive this coupon payment of $30 for 20 number of periods for 10 years. All right, let's kind of use the same example, just kind of work in reverse now. So now we're saying, hey, what's the rate of return? What's my yield to maturity? So I'm going to use the rate function here. So I'm going to f of x, I'm going to find financial, I'm going to find rate. Hit OK. All right, so the number of periods again, remember that was for 10 years, but we got to double that, so that's 20. We got a $30 every 6 months. We paid the $864.10, so negative $864.10, and we would get $1,000 back in the future. But notice it says 0.03999 or 4%. But again, remember, in order to really state this as a true annual rate of return, I got to double this. So I say equals 4% times 2, and that matches up to saying, giving us that 8% required rate of return, which we see up here. So these are a few examples to help you think about the concepts of present value and that inverse relationship. You know, thinking present value is the price we would pay for the bond, and we use rate function in Excel for the rate of return on a bond. And again, the examples of the textbook, these are annual examples, but reality is that most corporate bonds pay semi-annual interest. And that ends our lesson.